Is our nation actually teetering on default?
It is a very possible chance that the U.S. government needs to default. And if that was to happen, it would be catastrophic for the economy.
And more importantly, what does that mean for your pocketbook? This is Quartz Smart Investing. There's enormous attention this week on what's going on in Washington and efforts to avoid a debt ceiling crisis. What's your take on what that means for investors?
It's certainly something that could instigate a lot of risk off or risk aversion, and it already has. You know, the U.S. economy has never been through an actual default of the government on their debt, on what they're owed, and that's a serious issue. But the way I'd phrase it is it's a very large tail risk, and tail risks are hard to quantify. It kind of puts you in a situation where you're trying to think of what is 0 times infinity, but in this case, it's not 0. It is a very possible chance that the U.S. government needs to default. And if that was to happen, it would be catastrophic for the economy. So there's real fear there, but the hope is that a resolution can be found before the X date cited by Treasury Secretary Yellen.
And what is that scenario should there be default? What does it mean for the markets?
Well, for the markets, I think some extreme volatility. And we don't even actually have to get to the default. I think as we get closer and closer to that date, that in itself is enough to instigate more volatility, both in the credit markets, the equity markets, the FX markets, all around contagion, and not just domestically, but globally as well, because of so much exposure and reliance on U.S. government debt. Again, for equity investors, some serious risk off. What could that look like? That could look like a drawdown in equity markets. It could look like defensive sectors outperforming a little bit, at least on a relative basis. And it could look like traditional volatility measures like the VIX and other implied volatility along further terms being elevated.
Speaking of equities, you have said that you think the market is due for a meaningful correction, default or not. What is that correction likely to look like?
We're looking, it's possible to be down even 10%. And part of that, what is difficult to really look at is it's not just predicated on tougher economic times or a potential recession, which is what we expect later this year, or even with the banks fallout. It's really not hard to go down 10% when you think about an appropriate multiple for the S&P 500 and look at our earnings estimate. So right now we're looking at about 10% contraction on the EPS on the S&P 500.
That's earnings per share.
Yes, earnings per share. And that contraction is not something unreasonable. If you've looked at how top line figures or revenues for S&P 500 companies have been trending, they're coming in at below 4%. Coming out of this earnings season. Now you tack on to that margin compression, which is that bottom line, the earnings per share figure. Once you take out all the costs and everything in your taxes and your interest, that bottom line figure has been compressing as well. So to put that all together, going down 10% on the S&P 500 to realistically reflect what earnings looks like and how corporates are progressing, that's really what builds our picture here.
And in terms of specific stocks and categories investors ought to be looking at, I know you're favoring small cap stocks these days. Why?
Well, small caps, within the small cap world, what we were favoring really was high quality. And the reason we are looking at that, when you think about investing styles, rather than thinking about in each sector, you look across all sectors. And you think about what is a characteristic of some of the stocks I would want across all sectors, and high quality is one of them. High quality we define as clean balance sheets, low leverage, but also good stewards of capital. That really shows up in high return on equities, or ROIC. And these are the kind of figures we think about within the small cap space, because we think that will weather better during the recession, but also still has unexplored opportunities. It still has multiples that look reasonable. So that's a space within the small cap universe we like. But generally, we are still favoring and looking at large caps because they can have more defensive properties, particularly in equity pullback.
And in what industrial category should people be looking at to add to their portfolio?
Within industrials in the large cap space, we like the cap goods space. And something that stood out to us about capital goods is that the volumes that more capital goods companies have been able to maintain have been actually pretty decent, while other sectors of the market have been seeing volume pullbacks. And now you have this twofold. When a company is trying to earn money or make more revenue, they can either sell more widgets, as we call them, or they could raise prices. And raising prices, we've all seen with inflation that a lot of companies have raised prices and been making more revenues that way. But when you think about the real earnings, you have to also sell more volume, or volume becomes a weak point as you raise prices. But for cap goods space, we've seen that volumes have been a little more resilient, and it's made us a little more positive on that space.
We can't conclude a conversation without the R word, that's recession, and still talk of it in 2023. What's your assessment?
So we expect GDP contraction to begin towards the back half of this year and to really hit its most painful point in early next year. When we think about a GDP contraction, we can think about quarter over quarter, but another way to think about it is peak to trough. And we're looking at a peak to trough from around third quarter this year being the peak, and early next year, probably around first quarter of next year, peak to trough, thinking around 1.8% contraction. Now, to put that in context, in the Great Financial Crisis, we saw a peak to trough contraction of 3.8%. And on average, throughout cycles over many decades, peak to trough is around 1.6, 1.8. So these figures are not too extreme. We're not expecting a horrible recession, but it still can be very painful depending on how consumer spending holds up.
Well, we'll see what happens, and a lot will between now and the third quarter, Anna. Thank you for joining us. For more of today's top business news and insightful analysis, stick with QZ.com. Thank you for joining us, and tune in next week for another edition of Quartz Smart Investing.